Every administration, America goes to war. And every administration, somebody gets rich. In 1991, it was oil security. In 2003, it was reconstruction contracts. In the 2010s, it was drones and surveillance systems. The justifications change, the battlefields change, the headlines change, but the economic pattern doesn't. You've been told wars in the Middle East are about security, about nuclear threats, about protecting allies and maintaining stability. That is one way to look at it. Here's another. While you were watching the news coverage, defense stocks surged 40%. Energy companies locked in $1 billion a week in extra profit. And people with access to classified strike intelligence placed bets on prediction markets 1 hour before the bombs dropped. This isn't just a war story, it's a business story. And once you understand the business, the war makes complete sense. To understand why America keeps going to war in the Middle East, you have to understand one mechanism that almost nobody explains in plain language. The global economy runs on oil, and for decades, international oil transactions have been priced almost exclusively in US dollars. Every industrial economy on Earth needs dollars to buy energy, which means every country on Earth is permanently tied to the American financial system. That arrangement is called the petrodollar, and it didn't happen accidentally. In 1971, President Nixon ended the convertibility of the dollar into gold, a moment known as the Nixon shock. The entire monetary architecture built after World War II suddenly needed a new foundation. So the United States negotiated agreements with major oil producers, including Saudi Arabia, reinforcing the practice of selling oil in dollars. The effect was profound. If oil, the world's most important commodity, was traded primarily in dollars, then every industrial economy would need dollars to buy energy. That demand reinforced the dollar as the world's reserve currency, and it linked energy security, monetary policy, and military power in ways that still govern global politics today. But that power only holds as long as oil markets run through dollar-denominated systems. The moment the Middle East starts trading energy in yuan, euros, or anything else, dollar dominance erodes. American borrowing costs rise. The U.S. loses its ability to finance its own government by printing money the world is forced to absorb. So when instability breaks out in the Middle East, America doesn't just tolerate it, it manages it, it shapes it, because instability that keeps oil dependent on dollar systems, that keeps rival powers destabilized, that keeps American weapons and American energy in permanent demand, is not a threat to American power. It is American power. The Iran war isn't a deviation from that system. It's the system working exactly as designed, and the profits flow in 3 directions. The morning after Operation Epic Fury launched on March 2, 2026, the market opened. Before a single press briefing had finished, the companies that manufacture American weapons collectively gained tens of billions in market capitalization. Northrop Grumman up 6%, RTX, Raytheon's parent, up 4.7%, L3 Harris up 3.8%, Lockheed Martin up 3.3%, Boeing up 2%. These aren't bystanders. Every missile fired is a replacement order. Every system degraded is an upgrade contract. The war isn't a cost for them, it's a revenue event. 2 months before the first strike, Lockheed had already signed a deal to quadruple THAAD missile production, from 96 to 400 units per year at $12.77 million each. Their stock rose 40% between that signing and the first bomb dropping. They didn't predict the future. They invested in the infrastructure of inevitability. Now ask yourself who funds all of this. Lockheed pulls 74% of its revenue from the Pentagon contracts. Booz Allen Hamilton pulls 98%. The Pentagon is now preparing a $50 billion supplemental budget request, which will be funded by proceeds from American energy sector. After the strikes, Morgan Stanley told its clients to increase exposure to defense and aerospace, sectors where government spending, in their words, drives multi-year demand. That's not geopolitical analysis, that's a profit forecast built on the assumption that this doesn't end soon. The most honest truth, the greatest threat to defense investors is peace. When Russia-Ukraine talks began, defense stocks sold off immediately. Investors priced out the conflict premium. Peace is a financial risk. War is a financial asset. RTX redistributed $56 billion to investors over the last decade, funded the entire time by public defense contracts. Revenue comes in, shareholders take out. The war resets the cycle. The second vector is where the petrodollar logic stops being theory and becomes a balance sheet. Here's the geography that matters. Iran sits directly on the northern shore of the Persian Gulf. The Strait of Hormuz, the narrow choke point at its mouth, is the passage through which 1/5 of all oil consumed globally must travel. There is no alternative route, no pipeline bypass, no workaround. If the strait closes, the global energy market seizes. When the U.S. struck Iranian nuclear and military facilities on March 2, 2026, Iran did exactly what strategists had wargamed for decades. It hit back where it hurts. Iranian forces targeted vessels transiting the strait, bringing shipping to a near halt. Then they struck further, hitting Qatar's LNG export facilities, knocking the world's second-largest LNG supplier completely offline. This sequence is why U.S. crude jumped from $67 a barrel to over $90 a barrel overnight. It wasn't speculation, it was the market pricing of physical reality. A massive chunk of global energy supply had just gone dark, and there was only one country positioned to fill the gap immediately: the United States, the world's largest LNG producer. American LNG exporters are now pulling in roughly $1 billion more per week. Uncontracted U.S. volumes, about 15% of total exports, are selling on spot markets at peak crisis prices. Venture Global CEO made it explicit on a March 2nd earnings call, the same day the war started, announcing his company has the most available cargoes ready for spot markets. This is not coincidence, this is positioning. We've seen this before. When Russia invaded Ukraine in 2022, ExxonMobil recorded $56 billion in profit, a company record, while European households rationed heat. The same playbook runs now. Chevron, ConocoPhillips, Cheniere, ExxonMobil, all positioned identically. And here's what never gets the headline it deserves. American consumers pay the war premium too. The Energy Secretary approved an LNG export expansion last week, sending more American gas overseas at crisis prices, while senators wrote publicly that the same policy was driving up utility bills for American households. The structure is clean. Extract American gas, sell it globally at war prices, charge Americans those same war prices at home. Profit flows to shareholders, cost distributes to everyone else. And underneath it all, the petrodollar stays dominant. Every barrel sold in crisis conditions is a barrel sold in dollars. American financial supremacy gets renewed every time the Strait of Hormuz closes. The third vector is the most legally exposed and the most underreported. Before the strikes, a pattern emerged on prediction markets like Polymarket and Kalshi.
Another form of war profiteering is highlighted in The New Yorker, how to prevent insider trading on Trump's wars. 6 anonymous online gamblers made $1.2 million betting on the initial US strikes on Iran. Crypto analytics firm Bubblemaps suspect administration or military chain of command insiders acting with inside classified information. This is something that, of course, would be insider trading if it were the classic stock market, but it's not. It's on websites such as Polymarket, the much less regulated cryptocurrency-based prediction markets.
Under commodity trading law, this is illegal. Trades based on advanced knowledge of military strikes are prohibited, because financial incentives for violence is exactly what that law was written to prevent. Now, here's the structural problem. Donald Trump Jr. sits on Polymarket's advisory board. His fund invested an undisclosed amount in the company. He also advises Kalshi, Polymarket's primary competitor. The president's media company launched its own prediction platform, Truth Predict. The Trump family is financially embedded in prediction market infrastructure. The Trump administration controls what intelligence gets classified, and classified intelligence determines who wins bets on military strikes. Put these pieces together and a broader structure emerges. Defense contractors benefit from increased military spending. Energy producers benefit from price volatility and supply disruptions. Financial markets respond instantly to geopolitical developments. None of this requires conspiracy. It requires incentives. Modern conflict sits at the intersection of government policy, global energy systems, and financial markets. Each of those systems operates according to its own logic, but when they intersect, the economic consequences can be enormous. Eisenhower called it the military-industrial complex in 1961. What he didn't say, or perhaps couldn't say at the time, is that it was also a currency system, a mechanism for sustaining American empire not through force alone, but through the economic architecture that force protects. The petrodollar isn't a theory, it's a policy, and the Iran war is its latest proof of concept. We aren't watching a war. We're watching a business model run its cycle, with your tax dollars as the input and shareholder returns as the output. Subscribe if you want more structural analysis.